Hello friends, today's topic big correction in US starting in India to question mark. Nasdaq index of US has fallen by 11% in just 3 weeks. It had touched a high of 20,690 on 10 July and yesterday 3rd August it fell to 18,441. In stock market terms, it has already reached a correction zone in a short period of time. Although there is no specific definition of bear market, the following are commonly accepted definitions. Correction: when a stock or index falls by 10% or more but below 20% from a recent high, then it is generally called a correction. Bear market: when a stock or index falls by 20% or more from a recent high, then it is generally called a bear market. Hence, as of now, US markets has entered a correction phase since it has not fallen by 10% from a recent high. If this particular downtrend has to be called bear market, Nasdaq has to fall to around 16,550. So it is 9% away or 1,890 points away from officially entering a bear phase. Similarly, Nikkei index of Japan has fallen by 15% from its recent high touched on July 11. It is in fact very close to entering a bear phase. Nifty has fallen by almost 1.2% on Friday. It looks Monday also could be negative. However, it is hardly 1.4% from the recent high. In order for Nifty to enter correction phase, it has to fall to 22,570. Global stock markets on Friday: Hong Kong Hang Seng minus 2.12%, Japan Nikkei minus 6.17%, Germany DAX minus 2.39%, France CAC minus 1.64%, UK FTSE minus 1.33%, US Nasdaq minus 2.43% on 2nd August. Many investors have been getting a doubt and asking us whether this is the start of a bear market. As of now, it is too early to guess. However, global cues are extremely negative with a fear of recession in the US. As such, it is quite common for an index to fall by around 10% at least once every year. Here in front of you is a graphic description: bull market, bear market, bull market, bear market, etc. and the corrections in front of you in the graph. Why many people are panicking even for a small fall is that most investors may be new to stock markets and they have not experienced any big fall since more than 3 to 4 years. Periodical corrections are always important for markets. Usually, bull markets last for 4 to 5 years and bear market lasts for 1 to 2 years. However, there is no rule that it has to last for a particular number of years. Hence, a full stock market cycle will last for 8 to 9 years usually. But in the last few years, the cycle is shortening. Nobody can predict exactly when bull market will start or end and when bear market will start or end. There is actually no need to predict bear markets also. We just need to know what action we need to take when market rises or falls. Suppose this turns into a bear market, your approach to investment should not change. An investor becomes mature and experienced when he sees both bull and bear phase in the markets. As of now, most new investors have seen only the bull phase where markets have rallied continuously. There have been small falls during this period, but the overall bull market has been intact. Hold stocks only if you have holding period of minimum 10 years. Suppose you are over invested in stocks in this bull market, check whether the money is not needed for minimum next 10 years. If you require some money in 2 to 3 years, which is currently invested in stocks, you can sell some stocks, maintain correct asset allocation. Ideal asset allocation could be bank balance, PPF 10%, gold 5%, real estate 50%, mutual funds 15%, stocks 20%, totaling to 100. Don't plan your monthly finances based on bull market returns. In bull market, higher profits can be made in short term. Don't assume that the same returns will come in bear markets too. Example, your monthly expenses may be 40,000. You assume that you can make 10,000 profit every month and make an additional commitment based on this profit. It is not necessary that every bull market will end and lead into bear market. Sometimes bull markets can have multiple small corrections of 5 to 10% or more, and the markets can move in a narrow range for many months. At the end of the video, here is a question. In finance, what is called the invisible thief? There are four choices: A. Taxes, B. Interest rate, C. Inflation, D. Compound interest. If you are not the member of this channel, this is the time to subscribe. Press the bell icon. Send the video to all your friends. The video is good. Press the like button. Thank you for watching. Bye bye. All the best.